Dode, you're very tall, so I'm going to have to adjust the microphone down a bit. First, I want to start by extending a very big thank you to Dr. Savaş Alpay, the Director General of CESRIC, for putting together what has been, for me, a very informative and I think for the world at large, a very timely conference on a very timely subject. Excellencies, distinguished guests, and fellow panelists, the effects of the 2008 financial crisis were felt globally with repercussions hitting the real economy. Even if the crisis originated in the, some would say, the Machiavellian world of high finance on Wall Street. I personally vividly recall sitting at the helm of a global trading book of a multi-billion-dollar financial institution, working nights and weekends at times to try to mitigate the impact of the crisis on my erstwhile institution. At the time, we managed to successfully navigate the waters of this crisis. But there are casualties aplenty, with storied houses such as Lehman Brothers and Bear Stearns falling victim essentially to a culture of excessive risk-taking. More importantly, there were casualties aplenty in the real economy, with Main Street in pain as corporate layoffs surged and unemployment skyrocketed. From Houston to Hong Kong, citizens of our globalized world looked on with fear and trepidation as the financial tsunami unleashed by Wall Street crashed across the shores of the brick-and-mortar world that we live in. Factories shut down, putting blue-collar workers on furlough. Accountants, doctors, and entrepreneurs saw their economic opportunities shrink. Neighborhood bakeries, mom-and-pop stores shuttered their windows and went out of business. The world started to ask questions. Why was all of this happening? What allowed the institutions on Wall Street to take on such excessive levels of risk that ultimately drove the global economy off of the proverbial financial cliff? A consensus emerged that ultimately it was a culture of excessive risk-taking, which we've heard a lot about throughout the course of this forum. This culture of excessive risk-taking at the pinnacle of high finance was facilitated and encouraged by the artificially low interest rate environment that was brought on by the monetary policies of the former Federal Reserve Chairman, Alan Greenspan. In fact, as Congressman Ron Paul has repeatedly stressed and very eloquently captured, the world economy has been locked into a series of boom and bust cycles ever since the Federal Reserve System began to utilize interest rates as a lever to regulate the flow of money into and out of the real economy. So it's not really so much a question of whether or not there is sufficient regulation to inhibit excessive risk-taking. It's really more a question of whether or not the underlying system of interest rate-driven economics is damaging to the real economy. What about the global response to the crisis? The global response has been, as far as as far as I can see, as far as the many can see, it's been mainly corrective in nature, dealing with the surface of the problems and not dealing with the actual underlying root causes of the problem. We've seen the nationalization of several global financial institutions. We've seen bailouts worth several hundreds of billions of dollars. Some would argue trillions of dollars if we take into account the backdoor bailouts, the discount windows offered by the Federal Reserve System to the banks. These bailouts went to the very same financial institutions that brought on the crisis in the first place. In effect, the players that took on excessive levels of risk that brought on the crisis, that brought us to the precipice of a very serious situation, they weren't forced to bear the consequences of their financial irresponsibility. The banks that were on the winning side of their various financial bets, they gained a windfall in the form of higher profits, in the form of higher bonuses. As for the banks that were on the losing side of those financial bets, it's somewhat ironic, but they gained as well. They were bailed out by their respective governments at taxpayers' expense, at your expense, at my expense. It became a question of heads I win, tails I win. Ultimately, there was no real fix to the culture of disconnect between the real economy and the financial system. Wall Street traders and portfolio managers, looking up at their screens, only saw numbers. And they had no inkling as to the impact of their decisions on the real economy, on blue-collar workers, on mom-and-pop stores, on Main Street. This mindset needs to change. And all need to become stakeholders with a sense of accountability, a sense of responsibility, and ultimately, if we're going to lose, we're all going to lose together across the board. If an investment goes bad, we should all suffer the consequences of that decision. The global financial system ultimately needs to be a servant to the real economy, as opposed to lording over it, irrespective of the consequences. This endemic culture of dislocation, due to the lack of actually having a stake, due to the lack of actually being a stakeholder, it's led to an erosion of real and profitable project identification. Throughout the course of this conference, we've heard many of the speakers talk about the SMEs and how finance should ultimately serve the cause of the real economy. But that's not what happened. And the financial crisis brought that into the fore. To highlight this with an example, one need only look at Greece and what happened in Greece. If the providers of credit, the lenders, and the financial investors who were investing in those IOUs, who were buying those debt instruments, if they weren't so focused on that fixed rate of return and the higher earnings correlated to the credit ratings, maybe they wouldn't have lent this much money to Greece in the first place. Yeah. And Greece wouldn't be where it is today. and the European sovereign debt crisis wouldn't have unfolded in the manner in which it did. Investors would have looked at the real economy. They would have looked at factors such as demographics, industrial productivity, tourism, and the real potential. But the artificially high credit ratings that Greece enjoyed due to the membership of the Eurozone, it precluded almost everybody from conducting this very, very simple analysis that business people have been conducting since the beginning of business as we know it, since the beginning of time. Fortunately, as for the way ahead, and as this conference and as this forum has demonstrated, the outlook is clear, and one has room to be optimistic. In Islamic finance, there's no room for excessive speculation. Islamic finance, by definition, must be tied to the real economy, with investment opportunities in human development ventures, such as infrastructure, food security, and social services. As investors in Islamic finance, what's the main difference, you might ask? The main difference is that if there is suffering as a result of those investments, that suffering must be equitable. It must be spread across the board. All must be stakeholders, without ad hoc forced haircuts, as we saw in Greece, and later in an indirect form in Cyprus. And if the venture is profitable, that's great. All boats rise. The profit would be equitable as well, without having to deal with the burden of never-ending interest payment, debt servicing costs. Institutions across the world are beginning to look at opportunities within the Sharia-compliant investment space, which is a very real alternative to conventional financial products. And it can provide a reprieve from adverse global market conditions. While it might be somewhat disingenuous to say that the interest-free investor is immune to loss, is immune to market gyrations, the fact remains that the potential for Islamic investments to come to the fore as a less risky asset class are abundant, based on the fundamental tenets of Islamic finance itself. There was a recent report by PwC. Although the Muslim population in the world makes up roughly a third of the world's population, less than 1% of the world's financial assets are Sharia compliant. To me, this demonstrates the massive potential for the Islamic finance industry. The Islamic Development Bank Group, the IDB Group, which many of you in the audience are familiar with, has been a leader in this regard under the leadership of our visionary president, His Excellency Dr. Ahmed Muhammad Ali al-Madani. The IDB Group has long promoted the notion of responsible or ethical investments. Ethical investments are a natural part of the growing Islamic finance industry. The potential for Islamic finance to facilitate the growth of the real economy is boundless. And to some degree, it's stating the obvious. One of the key tenets of Islamic finance is that financing activity has to be based on real transactions, and it has to be grounded by real assets. Sharia-based investments, by definition, focus on the concept of fairness, risk sharing, economic purpose, and the need to avoid prohibitive and non-productive economic activities. Last year, at the Global Movement of the Moderates Conference in Kuala Lumpur, the IDB Group president talked extensively about the need to mainstream the notion of social capital.
2 minutes.
To moderate the capitalist-focused economic mindset. This can be achieved with an investment proposition on a human development-based economy. Investments that are focused on human development ventures are both not only more ethical, but in all likelihood, they're more profitable in the long run. One can get rates of return of 10, 15% in such ventures. And we look at these on a daily basis. An investment strategy that is solely based on immediate monetary gain will not result in an inclusive investment strategy in the context of human development. In the long run, such an investment strategy will only lead to wider gaps between rich and poor, and thereby engender social uncertainty on a very large scale. The IDB Group, over the last 39 years since its establishment, has invested directly in human development projects in each of its 56 member countries. The IDB Group has managed to maintain a very healthy investment portfolio with a cumulative investment of over $90 billion and a continuous AAA rating from all three of the global credit rating agencies, from S&P, from Moody's, and from Fitch. In the business that the IDB Group undertakes, on average, roughly 10 to 20% of the total cost of financing is borne by the IDB Group. As such, the real size of the portfolio is even bigger. However, the real size of the actual demand is a multiple of that. And the IDB Group can only serve a fraction of that demand. Therefore, there's a real growing opportunity for investment in human development, especially in IDB member countries. We need an inclusive investment strategy. And I will close off with a quote from His Excellency Dr. Al-Madani, where he says that an investment strategy has to follow the people. Distinguished guests, excellencies, and fellow panelists, thank you for listening, and thank you for being a part of this auspicious event.
Thank you very much, Abdullah.